Folks, welcome back to the Tailored Tax Show. This is episode 23, Tax Lessons from Heath Ledger's Estate Plan. And I'm Terrence Taylor, the co-founder of Tailored Tax. This is my partner, Big Al Darnell Jr. So what's up, Big Al?
What's going on, everybody?
As you know, the Tailored Tax Show is the podcast for highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers who want to learn how to save a bunch on taxes legally and perennially. So in today's episode, we're going to look at Heath Ledger's estate and what he did right, the things that he didn't do so well, the tax lessons that we can take from that. And then Big Al has been kind enough to put together a series of advice stroke tips, more so tips than advice, on the best way to handle your estate plan. And we just want to start with a disclaimer that we are sharing this information with you and reviewing this for information purposes to help all of us learn what we can about estate planning. Anything that we say here is for that purpose. If you want to take any action based on what you've listened to here, please consult with a qualified tax professional. And also make sure you talk with an estate planning attorney. So that was a long intro, Big Al, but let me hand over to you. Tell us a bit about Heath Ledger's situation as it relates to his estate tax at his time of death.
Of course. So we all know who Heath Ledger is. Probably one of the most epic jokers that has ever graced the silver screen. So the thing is, from a tax perspective and the estate perspective, Heath Ledger, he had about a $16.3 million estate, to our understanding from our research. And he had no spouse, but he had a daughter. He also, he passed back in January of 2008. And that was, of course, before, the Tax Cuts and Jobs Act in 2017, where it had an elevated $13 million worth of, $11 to $13 million worth of exemption. So his $13.6 million estate, the majority of it is going to be taxed. And like we told you on our last podcast, you have to understand there are some states that have estate taxes and others that have inheritance taxes. It's not just the federal estate tax, but you also have to look out for that as well. So that's pretty much the overarching situation. Of course, no one plans for death. He had it was deemed an accidental overdose on prescription medications, not overdose, but a lethal mixing of prescription drugs. So it wasn't an overdose, and nor was it suicide. And you'll see why I'm mentioning that now. But yeah, that's pretty much the overarching situation with Heath.
Okay, cool. So folks, Heath did some things right when it comes to estate planning. And one of those is he had a will. And in the will, he also was very clear to specify his domicile. And you'll see why this is important in a second. And in that will, he specified that his domicile was Australia, because at the time of the will, he was living in Australia. And then he also had set up a trust. And in that trust, he had very clearly stated how his estate should be divided or allocated. It was 50% to his siblings and 50% to his parents. And another thing he did right was he named an executor of his estate, and that was his dad. But Big Al, it looks like he did make some mistakes when it came to estate planning, and especially the tax aspect of that. So could you come in and share with us what some of the issues we discovered in our research are?
Definitely. So I'm just going to kind of categorize everything into three primary issues. The first issue is that although he did have a will, which is great, he didn't update the will. All right. And as I mentioned, he had a daughter, and the daughter was only 2 at the time of his passing, to my understanding, but he didn't update his will to include his daughter since her birth. Number 2, another issue was, Heath Ledger's from Australia, but he was living and working in New York, or he was living in the U.S. and working in the U.S. at the time, and also living in New York, which is where his passing happened. So now there was an interpretation of domicile, and here's why there was an interpretation of domicile, or why that was in the courts, was because if he's a resident alien in the U.S., guess what the U.S. gets to do? It gets to tax his worldwide income and his worldwide assets. But if he's a resident of Australia and a non-resident alien in the U.S., then his Australian assets wouldn't be included. So unfortunately, even though it was about even though his passing is never good, there's still a back and forth about money because of taxation. All right. And the third thing is that one of the great things he did is he had a life insurance policy to take care of his daughter. So it's not like he just forgot about her, but this life insurance policy, because she was a minor, became part of his estate at the time of his passing. It was a $10 million life insurance policy too. So now if you think about that, that increased the value of his estate that much more. So yeah, so now that you know the total situation, you know some of the things he did right and some of the things that we've noticed that were issues clearly. What would you suggest, Terrence, of what he could have done or should have done?
Yeah, and we're going to focus, we're going to stay in our lane, so we're going to focus on the tax aspect.
Yeah.
So, given that he had this life insurance policy that his daughter was named as the beneficiary of, and it was for 10 million, he could have set up another trust. And there's a very specific trust that allows you to set up to exclude the proceeds of your life insurance policy from your taxable estate. And that's called an Irrevocable Living Insurance Trust, ILIT, right?
Yep.
And that ILIT would have allowed the proceeds of his insurance policy, once it's paid out, to avoid being included in his taxable estate, and therefore the proceeds would have been tax-free to his beneficiary, in this case, his daughter. And another thing that we've highlighted in the other examples we looked at, which we'll come to in the end, Michael Jackson and Prince, is there is this strategy where, knowing that your estate is going to be taxed, and the way the tax code works is anything that's in a revocable trust is going to be subject to estate taxes. You then set up an irrevocable trust that has an insurance policy attached to it to pay for the taxes for your estate. And in this case, because his estate was valued at 13 million, and what's not clear to us from the research is whether that 13 million included the 10 million proceed from the insurance policy he took out, or if it actually excluded it. So for argument's sake, let's say that it excluded it. The implication then is his actual estate was valued at 23 million. So setting up an irrevocable trust and having this irrevocable living insurance trust, the ILIT, would have allowed for planning for paying the estate tax as well as excluding the insurance from the estate tax. So Big Al, that's a huge thing that we found out when we did the research for all three of this podcast, is many people are not really thinking through how to ensure that they've done proper tax planning for estate taxes, especially folks who are high net worth individuals who tend to have assets and income that is above the threshold for exclusion from estate taxes. It's really, really important to spend time working with an estate planning attorney, as well as working with tax advisors, qualified tax advisors, and professionals like us to plan how to exclude as much of your assets from estate taxes as possible, but more importantly, how to plan ahead to make sure you have enough money to pay for the estate taxes. Big Al, let me come back over to you. What else could we share about the Heath Ledger situation, and what else we can learn from lessons about taxes and estates?
Well, I'm glad you mentioned the ILIT, the Irrevocable Life Insurance Trust, because that is absolutely paramount to helping pay off of one of those larger estates when you know that it exceeds the threshold. And I believe the threshold at that time exclusion threshold for estates was like $1 or $1.5 million back in 2008.
Mm.
So that's clearly over 10 to 12 million that was
Yeah.
going to be taxed.
Yeah.
So no, I appreciate you bringing that up, and because it's extremely important for, especially for a lot of the people that we're dealing with, a lot of clients we're dealing with.
And Big Al, I appreciate you gently correcting my naming of the ILIT.
All good. You caught that? But yeah, well, but you know, hey, that's what we're here for, to help
Yeah.
each other out. So, because you helped me out a solid on that last one. But anyways,
Yeah.
let's getting back into it.
Yeah.
So here's what I would suggest is that for everybody that doesn't already have an estate or didn't do an estate plan, like I'll tell you this personally, when we did our estate plan, it included 4 areas. It was a will, a durable power of attorney, an advanced health directive, and a revocable living trust. All right. Now the thing is that trust has to be funded. But what I would suggest, and I found this article, it was great. It was a Forbes article, so I don't want to take the credit for it, but it was a Forbes article that by Ashlea Ebling, 8 Steps to Protect Your Family, and I'll just want to read some of those 8 steps. And I would suggest doing this, if not once a year, definitely whenever there's a major life change, such as having a child, getting married, getting divorced, or moving states, is to, number 1, sign a financial power of attorney. That way, your family doesn't have to jump through hoops to handle any financial affairs for, let's just say, money that you had in accounts that weren't already inside of the trust. All right. Number 2, execute medical forms. Like I mentioned, the advanced health directive and how you want things to go. But that's also in the case of everybody, it's not a clear-cut end of life situation. A lot of times there's situations where you're in a vegetative state or a state where they're keeping you on life support and you want to have those medical forms in place. So it's not just an after death, it's a near death, approaching death planning that you have to put in place. Next is calculate your net worth. Now, I'm going to tell you this, it's crazy how many people, especially my clients where I've talked to, I was like, did you know that you're doing pretty well? Your net worth is in the 6 or 7 figures. And they're like, you know what? I've just been working so hard. I never even thought about it. That's great. I don't feel like it, but it's great. And the reason I'm telling them this is to make sure that they are now aware there's other provisions that you need to put in place in order to protect what you have and to make sure it passes down to the next generation based on your intentions, your vision, your goals, your wish and dreams, and so forth. So take time to calculate your net worth. It's a phenomenal exercise, especially if you got a little something. Now, if you don't, it could be a bit discouraging sometimes, but yeah, but nonetheless, what we highly suggest that you sit down and calculate your net worth. All right. Now, the way to do that, as most of you all know, you take all your assets and just subtract all your liabilities. And whatever's left over is your net worth, but put it on a sheet of paper and know what that number is so that you're knowing what you're trying to protect and what you're working with. Next, review beneficiary forms. All right. You want to make sure that as things change in life, I've had death occur in my family. I've had shifts in my understanding and knowledge and exposure to other things that's happened as well, and other people's reactions, which has caused me to want to make shifts and beneficiaries, executors, and so forth. So make sure that you review that on a regular basis. Write or update your will. If you have an estate plan, just make sure you update your will for any big changes that come into play. Plan for state estate taxes. We all are aware of, familiar with, and can identify, hey, 40% top bracket for estate taxes federally. But there are about 12 states
12
in
states and the District of Columbia.
thank you, sir, and the District of Columbia that have an estate tax. But then there's also 6 states that have an inheritance tax, which is different. And then there's a couple of them that overlap. I think maybe 2 that have an estate and an inheritance tax. All right.
Just to be helpful to folks, we can even tell them what those states are.
Please do.
State tax, right? So if my screen will allow me to go up, but we'll start from the bottom. So we got Washington State, Vermont, Rhode Island, Oregon, New York, Minnesota, as we said last time.
Mm-hmm.
And I was actually surprised to see this, but the state of Maryland, the great state of Maryland,
Yeah.
that I know and love, also has an estate tax. And then I can't get my screen to go up. So,
Not a problem. Not a problem. I got a list over here as well. So let
oh
me
yes. So you want to take it up from Maryland?
Yep. So after Maryland, we've got. I'm sorry. Did you already say Pennsylvania?
Pennsylvania, I had not.
Yep.
So Pennsylvania has an estate tax or an inheritance tax?
Oh, I'm sorry. Pennsylvania has an inheritance tax. Thanks,
Okay.
Terrence.
Yeah.
Oregon, New York, Minnesota, as you mentioned, Massachusetts, Maryland, Maine. Then we have Illinois, great state of Illinois, Hawaii, the District of Columbia, Connecticut. But Connecticut also has a pretty large exemption too. But yeah, Connecticut would be the last one.
Okay. Cool. Thank you, sir.
No
Please keep
problem.
going.
Yep. So then, like that's number 6. Plan for state estate taxes. Number 7. Check the titling of assets. What this means is how you fund the trust. All right. The trust is literally a document, a legal document, just notating how things are going to, what assets should be in it, and how they should be handled in your demise.
Mm-hmm.
But to fund it, you have to switch over or sign over the title of your property, sign over the title of your accounts, sign over the title or the stock of a corporation or investments that you have into, or a brokerage account, into the name of the trust.
In
That's how
other
you
words,
fund it.
folks, you got to transfer the ownership of whatever you
There
got
it
in
is.
your name into the name of the trust. That's
Correct.
how you fund the trust.
100%. And then finally, give if you can.
Mm-hmm.
And the thing is that from a planning standpoint, that is a huge planning thing, because I know people that have 12 to 15 year plans of giving in order to just make sure that they can, I guess, spend out as much of their giving as possible as they're getting closer and closer to, certain ages in life, 80, 90 years old. But yeah, do that on a regular basis. And I know you might think that that's a lot to keep up with, but if you have a lot, then you're going to have to do a lot to keep a lot. All right, but yeah, back to you, Terrence.
Like that. So, folks, let's review these 3 examples that we did on estate planning and the tax lessons from estate planning. We started off with MJ, the man himself, Michael Jackson. And we realized that, man, he left a lot of money behind. His estate was ultimately valued. Oh, okay. Let me say, his estate was alleged to have been worth over billions of dollars. And I tend to believe that valuation because of the assets that were in his estate, the catalog for Sony, the catalog for the Beatles, right? So, but what was the lesson we learned from that, Big Al? We learned that when you have a trust, a revocable trust, you have to fund the trust. If the trust is going to do its job and protect your assets and ensure that your legacy, whatever you've left behind in your estate. And also from Prince, we learn it's super important to do tax planning for estate taxes. So you can minimize estate taxes, but also set up structures that can pay for your estate tax. So the bulk of your estate goes to the people you intended to go to. In Prince's case, we learned that he had 156 million estate, or it was valued at 156 million. And ouch, he paid 87 million in taxes. And Big Al, again, another shout out that we said we wanted to give to @Gene Evans 7885, who a few hours ago let us know that Prince had a will. And this, let me just do the quote. He had a will.
Allegedly had a will.
Comma. No, I'm doing a quote. So there's no
okay.
allegedly. This is a quote. Then we can talk about allegedly after. So the quote is from Gene. He had a will, comma. They raided his shit and burned it. So shout out to Gene Evans for letting us know that. So folks, now Big Al can come in. Prince had a will, allegedly.
Exactly.
Right? The
Allegedly.
lesson still stands though. If you had a will and they were able to get it and to burn it, you got to find a way to make sure your will is not burnable.
Or you have some sort of fail safes or second copies or
You know what I
digital.
mean? You got
Yeah,
to
yeah,
make sure. So, like for example, I got to make sure Big Eye has a copy of my will.
yeah,
So if and
yeah.
when it gets burnt, no, Gene. In all seriousness, you're probably sharing some really important information with
Yeah,
us.
I agreed.
But the main point is this: for the estate planning to work really well, and for you to be able to make sure that folks that you want to get your the things that you're leaving behind and you want them to inherit, you want to make sure it goes to the right people. You need a will, and also regardless of whether you have a will and if they found it and they burned it, ultimately if you don't do the tax planning for your estate taxes, then your estate goes down from 156 million to at most 69 million. And we don't even have the final details about how much of that 69 million actually went to his family, because sadly when you're into assets go to your intended heirs and the beneficiaries that you want to inherit your legacy, you got to fund that trust. And unfortunately for Michael Jackson, he didn't fund it by transferring ownership of these things into the name of his estate, and that caused a whole host of issues. And when we also looked at his estate, we realized that he most likely didn't do or get really good tax planning advice for his estate taxes, right? So, two lessons from Michael Jackson: fund your trust, and secondly, ensure you have a tax professional, a tax advisor, advising on how to minimize and also handle estate taxes.
And you
Second,
know what? Let me jump
yeah,
in there
go
right
for it.
quick.
Yeah, go for it.
In the case of Michael Jackson, we all know that he had that "This Is It" tour. All right,
Yeah.
and how if you think about it, it's almost like he foresaw because the title is "This Is It." You know. But anyways, so in that situation, also ask your attorney about a pour over will. All right, a pour over will ensures that any of the state's assets that are not already included in the trust will transfer into the trust after you pass over. So that kind of is a catch-all for everything that you didn't put in, because it's not like you could just put. Everybody takes time to put new things in every single month when they
Mhm.
don't think they're going to pass away. So that's all
Yeah.
I wanted to say about that one.
Appreciate you, bro. And let me also give a shout out, Big Al. We said we wanted to give shout outs here. I want to give a shout out to at Roger James 9160, who 3 days ago let us know that the audio on our Michael Jackson podcast was severely distorted. Hey, at Roger James, how bad? We'll do our best to make sure that the audio is much, much clearer. Okay. Okay, folks, continuing with the lessons of the estate plan series and taxes and estate planning series. So the second episode was on my favorite singer, Prince. And the lesson from that episode is that it's important to do the basics. Have a will, because that will direct the estate on how to divide and allocate what's left behind as an inheritance to the people you want your estate to go to. More importantly, in that episode, we also learned the very crucial role of tax planning as part of your estate plan. Because in Prince's case, his estate was valued at 156 million, yet only 69 million was left after 87 million was eaten up in taxes, lawyer fees, and 3 million in bank fees. So it's really important to do tax planning with your estate plan. In episode 3, we looked at Heath Ledger and his estate. And in this case, we learned the important lesson of updating your will when when life events and key situations such as the birth of a child occur. So in Heath Ledger's case, he had a will, he had a trust, but he didn't update his will. So his daughter, who was 2 when he died, was not in the will. And luckily for her, his family did take care of her. And his father was the executor of the estate. And ultimately, him and the other members of the family who were beneficiaries in the estate made sure that she was taken care of. So these lessons that we've shared with you over these 3 episodes on taxes and estate planning, or tax lessons from estate planning, show the importance of each of us making sure that we do the basics, such as have a will, and also do tax planning. So make sure you understand what a revocable trust is and how to use it, and an irrevocable trust is and how to use it. And then we also gave you the strategy of using the splitting of the assets of your estate into the revocable and irrevocable trust, because anything that's in the revocable trust is subject to estate taxes, and what's outside of the revocable trust is not. So when you split your assets and put some in the irrevocable trust, we also gave you the strategy of using a life insurance policy, such as an index universal life policy, to fund the estate taxes. So that way you can pay, or your estate can pay the taxes and preserve the value of the estate, so it actually goes to the people you care about, as opposed to losing most of it in taxes. We also talked about inheritance taxes versus estate taxes, and we talked about the 12 states that have inheritance taxes. So it's important to know these things. All right, folks, we hope this series has been helpful, and we'll see you soon.